So good morning, and thanks to the Federal Reserve Bank of Minneapolis, and especially the team at the Opportunity and Inclusive Growth Institute for putting this conference together and for inviting me to participate. As I said, it's great to be here, and I'm really excited to be talking about these issues and to get to see the community that is working on this stuff in the system. The pursuit of inclusive economic growth is at the center of much of my work. And it's a soapbox issue for me at a personal level. Economic inclusion has been a theme from my earliest days in the economics profession. A chapter of my dissertation, which was also my job market paper, focused on better understanding discrimination in mortgage lending. And my initial job as a PhD economist at the Federal Reserve Board of Governors focused on efforts to increase access to capital for those living in lower income and minority neighborhoods, and for minority and women-owned small businesses. Some years and a few career stops later, I joined the Atlanta Fed. In Atlanta, we use the tagline, "Everyone's economy," which I often modify to an economy that works for everyone. And that mission is grounded in promoting broad opportunity and inclusive economic growth. Now, as you probably know, Congress bestowed us with a dual mandate to promote price stability and maximum employment for the entire population. And here, let me say that I think of the employment mandate as a charge to foster sustainable maximum employment. And sustained employment is crucial because unstable employment, where one gets a job and then loses a job and repeats that cycle, is so very disruptive for individuals and households, and by extension, for communities. Now, one way we get to sustainable maximum employment is by maximizing human capital. Thus, my conception of sustainable maximum employment envisions an economy in which everyone who wants a job can find not just a job, but a job that allows them to use their talents and training to the fullest and earn a family-supporting income. At its core, sustainable maximum employment is about expanding opportunity. When we achieve our dual mandate of stable prices and sustainable maximum employment, the result is a more vibrant and inclusive economy, an economy that works for everyone. Now, several years ago, our bank embarked on a strategic planning exercise, and one outcome of that effort was identifying increasing economic mobility and resilience as a strategic priority. This appealed at the time and continues to appeal at our bank because, in my view, there's a direct link between our employment mandate and economic mobility and resilience. A household's economic mobility and resilience begins with a job, and it continues and strengthens when a householder keeps a job. So if we do better in attaining sustainable maximum employment, we will also be making progress in expanding economic mobility and resilience. And more broadly, I believe that the case is clear for pursuing economic inclusion, mobility, and resilience. Inequities put a ceiling on opportunity for millions of Americans. Limitations for workers limit employment, which limits the economic prospects of businesses, which in turn constrains local, regional, and national economies. Now, we don't know where the next innovator, the next great entrepreneur, or the next brilliant researcher is coming from. So we need to spread opportunity as broadly as possible to ensure that we are not leaving potential untapped. Now, you all know the research, but to quickly cite a couple of prominent studies, President Mary Daly of the San Francisco Fed and co-authors estimated that the racial and ethnic gaps in economic opportunity cost the U.S. economy almost $3 trillion a year in output. And another study by the USC Dornsife Equity Research Institute, PolicyLink, and Burning Glass Technologies showed that eliminating racial inequities in incomes could boost annual output by more than $2 trillion. Now, these are enormous numbers, even in a $25 trillion economy. And the lost economic potential could grow even larger in coming years, given that racial and ethnic minorities are projected to make up a larger share of the U.S. population in the decades to come. Gaps in opportunity happen not just along racial and ethnic dimensions, though. As one example, the rural-urban divides are stark in many parts of the country, as the evolution of our economy over the past half-century toward the service sector and white-collar jobs has disproportionately benefited metropolitan areas. So we should be thinking about these things in as broad a way as possible. Now, many of you are part of the Federal Reserve System, so presumably you know what we do to try and broaden economic inclusion. Now, numerous elements must interact to make sustainable maximum employment a reality, including, for example, having a quality education system and strong workforce development programs. Now, most of you also probably understand that the Federal Reserve cannot directly access or address these sorts of structural economic issues. Monetary policy, after all, is not well suited to target particular barriers to opportunity or specific populations or economic sectors. Yet there are things we can do. Obviously, we conduct research into economic disparities, and there will be several instances of that on display at this conference. This conference is also an excellent demonstration of another thing that we do, namely convene the best thinkers and practitioners to develop a deeper understanding of and explore solutions to important challenges. We can also promote by lifting up efforts that have proven effective in a particular locale, spreading the word about policies or programs where the evidence shows there's been a positive impact. Now, in that spirit, let me briefly talk about a couple of areas where the Atlanta Fed has had or is seeking to have a significant positive impact. Our bank has built an initiative we call Advancing Careers for Low-Income Families. Our team has conducted pretty groundbreaking research that shines a light on benefits cliffs that historically have functioned as huge disincentives for people in lower-wage occupations to pursue training and education, to climb a career ladder, and to achieve self-sufficiency, economic mobility, and resilience. The findings of this research served as one basis for important state legislation in Florida that broadens eligibility for the state's public children's health insurance program, truly groundbreaking development. And our team has formed partnerships with workforce agencies and other groups across the country who are seeking similar breakthroughs to improve economic inclusion and self-sufficiency. I'd like to quickly mention another aspect of the efforts of the Atlanta Fed and our sister reserve banks to open the doors of economics and finance fields to populations that by and large have historically not considered these fields as opportunities and options for them. Our economic education program is trying to inform and reshape K through 12 curricula so that people from all walks of life hear about economics and finance early in their lives and understand that they can access these fields and that there is a range of occupations at places like the Fed that tap into economic knowledge. In our teaching recruiting efforts, we're pivoting in a concerted effort to reach out to schools that train large numbers of people from communities underrepresented in economics and finance. Now, the goal of these initiatives is not to get to everyone to fall in love with economics. Rather, the idea is just to get more people to know about economics and to view it as a viable career choice, and make them aware that you can find jobs other than being a PhD research economist. Not that there's anything wrong with that. Ultimately, people need to choose pursuits they are passionate about, and you simply won't know if you develop a passion for something if you've never been exposed to it. Now, I want to also commend the work of our host, the Opportunity and Inclusive Growth Institute. I think this work has been nothing short of exemplary. Now, while there's a lot that's going on in the Institute, I'd like to give a particular shout out to the database that Abby mentioned, the Income Distributions and Dynamics in America resource, which is expanding access to the powerful information that lives within administrative data. Now, for many, that term, administrative data, sounds hopelessly dry. Not me, I love administrative data, actually. But as you know, administrative data is truly critical to what we're about in this work. And that's because it can represent very high quality data. And we are all aware of how difficult it often is to find high quality data when conducting studies into economic disparities. Now, I've long had the view that evidence-based research is essential to effective policy. And it's been a principle that has guided me throughout my professional life. We need sound research to undergird policy that seeks to reduce and eliminate barriers to economic opportunity. Because in important respects, the best ways to address economic disparities are still not well understood. And those knowledge gaps are among the reasons the nation has made only incremental progress on key dimensions of inequality. One quick example, the most recent survey of consumer finances from the Board of Governors, which is the 2022 edition, tells us that the median white family in America holds more than 6 times the wealth of the typical black family. And that gap has not narrowed much over several decades. Now, everyone here can help. I think every person in this room has the potential to deepen our understanding of how our nation can dismantle barriers to opportunity. And over the next 2 days, we will together explore research into important puzzles, including gaps in retirement wealth accumulation, the effects on home ownership of institutional investors in the single-family home rental business, the impact on income inequality of geographic differences in inflation, and much more. Now, you have the agenda, so I'm not going to recite all of it. But if I can take a speaker's prerogative and brag for a moment, you will hear from 2 Atlanta Fed economists today who I'm sure are going to dazzle you. David Wickser will discuss a paper on disability insurance that he co-authored with Timothy Moore of Purdue University and Amanda Michaud, a Minneapolis Fed economist and organizer of this conference. And right after Neel and I finish, and Amanda does a little opening remarks, another of our economists, Veronica Penchiakova, will present work on the origins of business formations. It's good to see you both here, and I'm really proud to see that you have prominent roles in this program. Now, suffice it to say, we're in for a couple of days of thought-provoking discussion. And this is super exciting. When leading thinkers get together and wrestle with important questions, it can yield key clues for broadening inclusion and opportunity. Now, I hope I've helped to frame what's to come, and I hope you're excited about this program as I am. I want you all to enjoy the conference and participate fully. Now, I'm going to go sit over here for what I think will be an interesting and lively chat, as it always is, with my friend and colleague, Neel Kashkari. Thank you very much.
Let me just add to Abby's thanks. Really appreciate you coming out here today for this conference. Let me start with this. You know, the Opportunity Inclusive Growth Institute is taking these huge issues facing society. And we have in the room health experts, people in education, people focusing on criminal justice. Almost every aspect of American life is somehow woven into these issues. So I'm just curious, you as a researcher, how do you decide where to begin?
So that's a big question. For me, I think, well, I'll tell it from my background, my perspective. So in my career, there were areas that I had passion in. So I cared about access to capital, mortgage flows, those sorts of things. And then I had to marry that with the data that I felt that I could get access to. So for my dissertation, it was right after the Boston Fed had collected all that information from the banks about their underwriting rules and tools, and it was publicly available. So in those days, you actually had to call them. The email wasn't so good. And they sent me a floppy disk with the data on it, and I downloaded all of it and just started running analysis to try to see if there were aspects of it that I hadn't seen people working on or revealing. And so that's kind of how I think about it. So I like to live in my passion spaces. I feel like that's the only way I'm really going to get through the hard parts of research, when your programs aren't converging or you're seeing bugs or all those sorts of things. And so it was essential. But then it's also trying to be creative about where you think there might be data, and then being persuasive to try to convince people to give you that data. It's one of the reasons why I think that the added database is really important, because then that part of the effort has been handled already, and you can spend much more of your time and your focus on the questions to be answered. But it's an ongoing thing, and one of the things I've been trying to encourage businesses and public sector agencies is that they should be thinking about their data as a resource to help them And as you think about how you collect it, how you store it, how you manipulate it, put the research component into this to make it easier for all of us to be helpful. Because when researchers learn things and they bring it back, it can actually help these programs work better, and it can help the outcomes be better as well.
So that makes a lot of sense. But now think about, I get it from an individual graduate student's perspective, which you were very clear on. What about you've been president of the Atlanta Fed for quite a while now. How do you think about guiding the Atlanta Fed? Now you've got the resources of the Atlanta Fed and the Federal Reserve System behind you. How do you think about where to focus?
So I don't. One of the things that I try to do, I feel like I'm an aggregator of perspectives and viewpoints. I go out, I talk to a lot of people, and I try to ask, like, what are you struggling with? What are the things that you're worrying about? I bring those things back. Like, so my job, I think, is really to just give a picture of where people are struggling, where people see there are opportunities, where people have hopes or wishes that things could work better, and then just put them out there. And then, I have a great team. I talked about a couple of them earlier. Karen Kopecki's here. She used to be with us as well. They all will know, I hope they know and get a sense of which of these issues are closer in their passion spaces to where they might be able to advance things moving forward. As you noted, it's a super complicated world. There are so many different fields. There are so many different details and institutional knowledge that you could have, that trying to have insight to say that's the one that will make the difference or that one will, I don't think that's helpful. It's really going to be everybody coming together, and it'll be the aggregation of all that knowledge that works.
Related to that, one of the initial ideas of the Institute was to have a very broad mandate related to these topics, but intentionally invite people beyond just economists to the table, because there's so much knowledge and expertise that they bring that historically, as a Federal Reserve System, I don't think we have fully appreciated or embraced. And so I'm really happy that we have economists here today, but we also have other experts.
So can I just speak to that? Totally agree with that. One of my, the best class I taught, my favorite class to teach when I was a professor, was the class I team taught with a historian. And it was about urban economics, but the history lens kind of lifted up a different set of things, that history happens in sequence and in context, and there are all of these relationships that will drive the setting by which policy gets pursued, the way that programs or potential initiatives might be articulated or considered. And if you're not totally aware of that, then you can miss things in terms of how you might design an analysis, because no initial context is totally random, and having an appreciation for that moving forward is quite important. So I love the multidisciplinary. My undergrad, I was a psych and econ person, right? So I already had some predisposition to that, but it's really interesting.
We can have a long conversation about that. I'm going to keep going, though, because I want to make sure we have time for the audience. Of all the topics that one could approach, I know, and you touched on it in your remarks, the benefits cliff work is a signature issue for the Atlanta Fed. How did the Atlanta Fed get into that work? You gave an example of where it's making a real impact. Where do you see it going?
So this actually started before I got there, and there were so Dave Valtig, who was the research director at the time, had this passion about trying to understand sort of what were true barriers to families and moving to self-sufficiency. And he worked with some private sector folks to build a tool that could actually kind of map out the trajectory of your income if you were participating in different mixes of social welfare programs. So housing vouchers, child insurance, all those sort of things. And they could show sort of when you get to a certain level, because these programs are being tested, you get an extra dollar, you start your progress slows or sometimes falls backwards. And they started mapping this, and they would bring it out and talk to folks, and people didn't know. Like, they weren't aware that the incentives were such that people were locked in, not because they didn't want to be better, but because the incentives made it less.
But the participants figured it out.
Oh, they
the
knew.
policymakers didn't know, but the participants
no,
knew.
they did the math,
Yeah.
right? And so we actually started doing math, and we would ask the question, well, okay, suppose someone worked through the cliff anyway and decided to make themselves better. How long would it be before they broke even? And in many places, it was 10 years, 12 years, 15 years, and that's not viable. Like, it's not reasonable to ask someone to do that if you've got children you've got to support, if you've got like elderly people and all those sorts of things. That is not the rational decision. That actually not bettering yourself is rational. Then we did one other thing, which was we asked the question, did the thought experiment, well, suppose you had two people who are identical. One, you decided to pay to fill in the gap, and the other you didn't. Who do you spend more money on? And it turns out you spend more money over the lifetime of that person for the one you don't fill in the gap, right? So there's a fiscal cost to this in addition to sort of a self-sufficiency and a social cost. And once people saw that, they're like, well, we got to do something about this immediately. And that's triggered all of these partnerships and memoranda of understanding that we've had, because now all these counties, and a lot of these rules are set, the variation happens at the county level. They want to figure out how to not do that. And so the Florida action was to sort of not make the penalty on the children's health insurance be acute. So they raised the poverty threshold to 300% of the state poverty level from 200%. And the difference between being covered and not covered in terms of a premium was going from something like $300 to $3,000.
Wow.
Right? It was sufficiently large that nobody was going to cross that threshold because the extra income wasn't going to be enough. Right? And so it's that kind of stuff that has been very interesting. And the team has been quite creative in presenting this in ways to make people understand, like to talk about it in their domains so they get it. And you know, so much of this is the analysis plus a communication strategy that makes the issue or the solution compelling. And so you've got to have that partnership.
Excellent. I've got two more questions, then we're going to turn to the audience. You touched on in your remarks challenges in urban centers, challenges in rural communities. We face that dramatically in the 9th Federal Reserve District. We've got these big cities for us, Minneapolis, St. Paul, and a lot of rural areas around us. Curious, what do you see? What are some of the common challenges? What are some of the different challenges?
Yeah, so there's so many. So one is just having an infrastructure in place that can support the way business happens today. The most obvious element there is broadband. So many businesses require on having that technological connectivity, and broadband doesn't exist in robust ways in a lot of rural places. It's hard to get out there. Like, just the business model for a private company to do this doesn't really work.
Correct.
And so you need to find some way to subsidize that, and policy is trying to address that. Second thing is, and that actually leads into a second thing, which is trying to create the possibility that the next generation sees opportunities located locally. Right, so one of the concerns is when children are growing up, they think, well, where am I going to get a job like that's going to be interesting and allow me to progress? If they don't have broadband, if you don't have the innovation, if you don't have the entrepreneurship that's visible and local, then they're going to say, I got to go somewhere. And that then runs the risk of leading to the spiral where the place can't be sustaining on its own. Another area that I hear a lot about is childcare. And it's particularly important because the population is far less. So you can't just assume that there are going to be neighbors that might be able to watch the kids or any of those sorts of things. So the existence and presence of these institutions is quite important. And then the last one I would just talk about is healthcare. So across this country, in my district, and I'm sure this is everywhere, like, hospitals are closing in rural places. You can't get a lot of the important healthcare that you need to have. And that then becomes a challenge for, can you stay there?
Yeah.
Like, if you can't get the healthcare that you think you're going to need or your family's going to need, like, you might need to do a different calculus to figure that out. And so finding solutions for all of these is of paramount importance if we're going to close this divide. I'll just say on the childcare, I think there's a huge opportunity if someone could develop a business model to deliver childcare in these type of places. I think there's a communication aspect to this, there's a coordination aspect to this, there's a certification aspect to this. If someone could figure all that out, the challenge is so ubiquitous in these areas, I think it would be very interesting.
All right, well, we could have a long conversation about that because I've got two very young children, so I'm in the childcare market and have analyzed this in some depth.
Well, you could be the
And
one. You could be the one.
I don't think it's solvable by the private market. It's like, I'll give you just a quick riff. At the same time that childcare costs for families are so high, childcare wages are very low. Those two things seem to be in tension. Well, it's because the more you make it a living wage, the less affordable it becomes for families. So it's like, why does every country in the world subsidize agriculture? Because they want high prices for farmers and low prices for consumers. Those two things are directly in tension. So the only way to square the circle is with some form of subsidy. Otherwise, it's just impossible. The private sector cannot solve it on its own. My conclusion, I'm not advocating anything. I'm just making an economic observation.
This is lived experience, right?
This is lived experience, and I finally tried to cut through what I think is kind of like a Gordian knot. Last question for you is, you talked about maximum sustainable employment. Since we've both been at the Federal Reserve roughly the same amount of time, before the pandemic, the FOMC, us included, kept getting surprised that the unemployment rate went lower, down to 3.5%, and we didn't see inflation. Now we're at 4.2% unemployment, and we all think we're somewhere around maximum employment. I'm just curious, in the arc of what you've learned in the last 8 years or so, how do you think about maximum sustainable employment, and how will we know it when we're there?
So, I
saved the hardest question for last.
Yeah, this is a big question. So let me just say, look, I think that there is sort of a short-run maximum employment, and then there's the real maximum employment potential. All right, so you could take where everybody is in their human capital and where they are in their employment as fixed, and that will define one level of maximum employment. But the question that I always ask myself is, well, am I happy with that? Or should we be striving to do better and improve people's productivity, get them into better matches, get them better human capital, such that the benchmark will actually move? And I think if we do our job well, the benchmark should move. And I think one of the things that we've learned is that there has been movement, right? So like when I started being an economist, the idea of the natural rate of unemployment was well north of 5%. It could be almost 6%. Now, when I started here, it was 4.4. We got to 3.4, right? So it's obvious that the notion of what this is evolving and shifting. It shifts with technology. It shifts with how we provide supports. And so for me, I view the exercise as trying to reduce something equivalent to a dead weight loss. Like, to what extent can we position every person so that they are their best self, that they are doing the best work of their life, the best productivity of their life. And if that happens, then our economy is stronger, our economy is bigger, our economy is more resilient, and our job actually gets a whole lot easier. There's less that we have to do. And so that's how I think about it. Now, everyone always then wants to say, well, what's the number, right? I don't really know what the number is, right? But I know that the number could be lower, right? And you were a strong voice through that period when we were getting below 4 to say, let's not jump to a conclusion, because our institution has historically been preemptive.
Correct.
Right? And not allowed those last few people to get jobs. And then we learned, if you let them do it and you manage well, those can actually be sustainable jobs. And so, to me, I think this is an area that we need to continue to be focused on, thinking about, and being creative to try to find ways of how to quantify this, and to find the places. I use the phrase, an economy that works for everyone. It naturally flips to, well, for whom is the economy not working? And that's where our potential is. Like, that's the space where we can actually close that gap and get much more to that real highest potential number.
Wonderful. All right, let's open it up to our experts in the audience who might have questions. There are a couple microphones around. Shy group this morning. Okay, I can keep going. you talked about the urban-rural divide. What you described in your district is almost exactly what I experience traveling around our district. And I'm just curious, healthcare, for example, you talked about that. Hospitals are closing. Hospitals are closing here too. But here, technology is showing some promise of closing some of those gaps or increasing access. You don't have a specialist in your town, but maybe through technology, you can actually access that specialist. Are you seeing progress there?
Yes, so the telehealth and the use of technology has been very, very interesting. And this is like with all these different frontiers, you see the opportunities, but then you also learn new challenges, right? So definitely the potential to use people's phones, people's laptops for apps, for having appointments, for having communication, that all has increased. The challenge we have, so yes, so we need to see that, and we need to see that become more sophisticated, more nuanced, more innovative, and all those things. The challenge is that it then requires like a level of personal self-discipline that I think can be challenging. Like we know that many of our health issues are not because people don't get the medicines, is that they don't take the medicines or follow the protocols as ruthlessly as they might otherwise. And so then the next challenge is then how do you incentivize that? How do you create processes to address that in this new domain? And so there's all that learning that's going to happen that I think it can be done, but it's going to take work, it's going to take investment, and I mean, I'm actually fairly optimistic on this because it covers such a wide area that I think policymakers will be able to gain consensus on this because it's everywhere, and that's quite interesting.
One other thing, just jumping around, just because it's partially in your district, obviously the hurricane, very big news, a lot of damage, especially in North Carolina, which I know is not in your district. I'm just curious, what kind of reports are you all getting from around your region in terms of the effect, and how are people navigating it?
Yeah, so my district has been facing these sorts of things with increasing frequency. So when I first started, there had never been a hurricane, a storm that had gotten to Atlanta and was hurricane strength. I started in June. In September, was the first time that it ever happened. It's 2017. And then you have Helene, which is like this massive storm into the Appalachian Mountains, which
is amazing.
Is not close to the ocean, right? And yet the storm can still have that kind of power. To me, it's really causing everyone, like what I'm seeing is it really causing everyone to rethink what their relationship to risk is and how geography plays a role in it. So I've talked to a number of people in the last month and a half who are either rethinking their decision to buy something on the coast or regretting their decision to buy something on the coast because they didn't appreciate how powerful and how rapidly the dynamic has evolved. Right? When you used to have, where you thought you had 50 yards of sand that was going to be a bunker, it's not that much as much of a bunker as people have thought, and that has real implications, I think, for how all these places are going to work. So I was talking just with someone yesterday. That whole area in North Carolina around Asheville, there are going to be some hard decisions that have to be made about like how viable is the place if this sort of thing could possibly happen again.
But if it could happen there, it could happen in a lot of different places.
That's correct. And so one thing I've been hopeful for is that people throughout the country actually take on board the experiences of their neighbors a bit more in making judgments about what their actions should be, what kind of precautions they should take, how should they think about their posture. Now, that hasn't happened as much as I would like. And there have been, as I said, there have been these giant storms coming across the Gulf Coast, and my district covers the whole Gulf Coast except for Texas. And then I have also part of Tennessee. There's not as much mitigation as I think one could do. And at some point, I hope that people kind of step back and say, collectively, we've got to figure out what we want for our community and how are we going to make it more resilient against these things, and that'll be really important.
Here in our region, I'm sorry,
Yeah,
go ahead.
let me just say one other thing. What we are seeing, which is important, is that the private sector is making choices as well, right? So in Florida and other parts of our district, insurance rates have gone up a lot, like 300%, 400%, adding thousands of dollars of cost because there's math there, right? So if their actuarial tables, I guess not actuarial tables, but their risk tables were, the storm of that magnitude and that loss is only going to happen once every 70 years, and now it's happened 3 times in 5 years, those premiums don't work anymore. Like, you will go out of business. So just the economics of it means that the economics of living in these places is going to change, and that's not a policy thing. Like, that's a business thing.
Right.
And businesses are going to start. I think we're going to see more and more of that in the years to come, because I don't think these storms are going to stop happening.
So it's interesting you say that, because we have a couple insurance CEOs on our board of directors, and we talk to other members of the insurance industry, and I ask them, I say, can you explain to me why are premiums in our region going up so much? We don't have hurricanes here, thankfully. And they say, yeah, but it's a national market. And so, yes, the storms that are affecting the Gulf Coast, forest fires, they're actually getting spread out across the country. And so that's one of the factors that's driving premiums up all over the country. So it definitely is it's a big problem.
It's getting folks' attention for sure.
We got 2 minutes left. Any remaining questions that folks have? I see one over there. Go ahead.
Eric Hurst, University of Chicago. So when you're talking earlier about thinking about the sustainable unemployment, why the unemployment rate now as your target? I've talked to Andrea about it yesterday. There seems to be a much bigger class of people on the margin between working and not working, and so are we thinking about these kind of employment rate movements as a potential other metric? And when you start thinking about that, things make a little bit more sense when you're looking at the full group of potential workers.
So that's a very good point and a very good question. I would say there's not any one measure that defines sustainable maximum employment. But when you talk to regular people, labor force participation rate doesn't mean much to them. Right? So like, there are a lot of the things that we would use as measures of sort of penetration, growth, health, vitality, of all those things, but that's inside baseball. Everybody knows what an unemployment rate is, and so using that as one of the benchmarks is going to be useful, but we should not ignore any of the other things. And for me, I'm actually trying to ask person to person, like, what are your skills, what's your job, what's your attachment, like that's sort of the metric to think about sort of how well these labor markets are performing.
I would just add, so Andrea and our team here has heard me on this point for years, because when I first started, a friend of mine who's now the deceased, late great Eddie Lazier, labor economist, called me and basically said, you guys at the Fed need to stop talking about the unemployment rate. It's meaningless. You should be focusing on EPOP, because it takes out the psychological analysis of whether or not I'm in the labor market. And he just pounded me on that. And so it's something that I think he was right. I'm not saying the unemployment rate is meaningless, but EPOP is a very important measure, because when you see so many flows from out of the labor force into a job, right, that in theory that shouldn't happen, but a lot of people move from out of the labor force into the job. And so I think employment to population measures are very important. But I agree with Raphael, we have to look at all of it. There's a question over here.
Hi, Abdu Njai from NYU. So the opportunity to own a house, especially for young households, is certainly an issue currently. But I wanted to just, from your work and from how you see it now, whether this is more of a policy issue now or a market issue.
Housing affordability, is it a policy issue now or just the market?
There's a lot of market, in the sense that the big challenge we have is an imbalance between supply and demand, right? So we don't have enough units for the number of people in most of the places where we're seeing growth, and that's putting a lot of pressure on things. That said, the cost to do things actually is not irrelevant, right? And so it can influence the intensity by which people are experiencing things and sort of make that larger dynamic feel more acute in places. I think, though, it's a hard question to ask. It's a hard question to answer because our charge is not to fix housing markets. Our charge is to make the U.S. economy be in a position that people have certainty about where it's going to be writ large 3 years from now, 5 years from now, 10 years from now, which is why we want to have stable prices. But it does have implications on how people are going to experience things. I'm hopeful that in the next several months, as we start to normalize our policy, that the pricing for mortgages gets to a level that allows a little more action in those markets. I mean, we're seeing that already. Financial markets are responding quite quickly, but we have our charge, and we have to face that.
Abby, any final? You had your hand up earlier. Microphone's coming to you.
Did you have a question? So when we are talking about maximum employment, and you mentioned maximum sustainable employment, I feel like that pulls in the idea that there might be different ways of achieving it, and there might be different, in a sense, levels of maximum employment as defined by a simple unemployment rate, but things that could look very different in that they impact different types of folks. It brought to mind kind of how the full employment mandate originated, and it originated not that long after we started really thinking about human capital and as a profession. So when you think of the publication dates on human capital papers, not that much before the kind of dual mandate, we now know a lot more about how to generate that and causally affect that. So I'm just wondering, do you think there's, given when that originated, is there a bit of a mismatch in just institutionally how we think about full employment as perhaps a single static thing as compared to a choice among many equilibria that we can shift with our other policy decisions? Is there some mismatch in our own thinking or perhaps a mismatch in how we talk about it with the wider public?
Yeah, I actually think it's the second. Well, first, we're unusual as a central bank in having two mandates, right? And because originally it was just stable prices, the dual mandate came in during the civil rights era as people were concerned that just the basic institutions that were foundational were not thinking about these disparities. But then the question came up about how do you measure this? Like, what does it mean conceptually? How do you provide a framework that allows us and the public writ large to know whether we're making progress or not? I don't think that it has, well, as the earlier question noted, we haven't been able to reduce this down to a number or an index or anything in a way that's comparable to the clarity that we have in the inflation or the stable prices. Even though I would note there are 1,000 ways you can measure inflation as well. Like, we have an underlying inflation dashboard. We show 8 of them, and they don't always say exactly the same thing. So I actually think this is an area where research would be useful, like having some thinking from people who are deep in this space about sort of what would this look like? How do you think about talking about the concept of multiple equilibria? And how do you think about creating consensus on what an appropriate benchmark is? Maybe maybe there's an institute that starts a project to say, okay, we're going to measure what we think the frontier should look like and how far we are from the frontier, and we're going to update it every 2 years, 3 years, forever. I think there's a lot of hard thinking that remains to be done to help flesh this out in a way to make it actionable where everybody understands it.
I think we are over our time. So please, everybody, join me in thanking Raphael for his remarks today. Thank you. Appreciate it.